Hi all, so we're going to get into this section, which has been about public accounts, and we're going to shift a little bit. So the first two chapters, right, were over externality, which were the positive and negative that weren't necessarily. And then the second chapter, we got into public goods and common resources, and we discussed a little bit about ownership affects the efficiency of the system. Now we're going to change things a little bit differently. Now we're going to do a brief introduction of the design of the U.S. tax system, which this is the final aspect of public economics, which interacts with markets and affects our microeconomic level. So first off, let's look at the federal government. The federal government ultimately is the U.S. national government, right? So this is Congress, the White House, the Supreme Court, and all their associated branches. The federal government and Congress operate through collecting taxes in order to provide the services that they then offer and to enforce the regulations required to make them healthy. So we know that the federal government can improve upon market outcomes, but to enact its policies, this requires taxes. So the federal government for the United States actually relies on a lower federal taxation. In contrast, Denmark and Sweden are near 50%, and Germany and the UK are near 35%. So U.S. is of the developed rich countries, the United States is actually a lower amount of taxation generally than the other countries listed here. And so let's look at the breakdown of American taxation. Government revenue as a percentage of GDP looks something like this. If you notice, the U.S. federal government tax revenue is roughly 15% of GDP. In contrast, we added another 10% of GDP for state and local governments. So you'll explore GDP a little more in the macroeconomic videos in the macroeconomic context, but for now, what we're looking at is ultimately breakdown and seeing that the federal government, of all the income generated in the country, the federal government collects about 15% of this in taxation. Now, just to zero in, what does the federal government's taxes look like? Well, at the individual income tax level, it collects $1,075 billion. And for social insurance, this is our second largest category. And then corporate income taxes, a much smaller category than both these two. And then other taxes, which these could be things like tariffs. So in total, the United States collects about $2,500 worth of taxes. Now, a couple of things I want you to know. Notice that the first, individual income taxes, is for government receipts. What this is saying is that 43% of all government tax comes from collecting off of our income. So this is important because this tells us income is the key source of government revenue. But you also have some insurance taxes, which is 36% of the revenue. Now, what are those social insurance taxes? Well, the next time you get a pay stub, if you look at the end of it, what you'll see is that you're getting deducted, right, for things like Social Security, for Medicare, Medicaid. The taxes you pay to those specific services are social insurance. So your individual income taxes go to the general government fund, to general sources. But your social insurance taxes are meant to be dedicated to social insurance programs like Medicare, Medicaid, and Social Security. Notice that corporate income taxes are much smaller than this, 12%. And then other taxes are only 9%. So this is something, tariffs, for example, and government fees that they charge for service. Now, the U.S. operates on what we call a graduated tax system. And a graduated tax is a tax that scales according to a family's income based upon marginal tax rates. And there's types of income taxes, too. I should rephrase. This graduated tax scales according to the family's income, and these income taxes come in multiple different ways. You have the payroll tax, which is the one you and I are most familiar with, and that's a tax on wages a firm pays its workers. So if you look, the tax withheld from your paycheck, that is part of these payroll taxes. Similarly, you have social insurance tax. This contributes to social insurance programs, Medicare, Medicaid, and Social Security. However, you also have a corporation, which is a legal entity, which pays a unique double tax. Its income is taxed and its dividends. you might not know this, but we talk about corporations a lot, and a lot of people use it synonymously with businesses. That's not exactly what it's basically a legal entity you create in order to prevent from risk. So basically, a corporation, right, can own assets, it can own property, it can basically function as a legal person. But in doing that, protects it and the people invested in that company from being affected by if the company goes. So for example, if you own a business and you have no separation, your business goes under, and you're personally liable, which means that they can your car or your home. The corporation, however, you can own the corporation, and the corporation can own the restaurant or whatever business you're interested in operating in. And if that's the case, then if the business goes under, the corporation is what you lose and all the assets tied to it, not your personal private. Now, you might have been wondering, why is its income tax so low? Well, part of that is it is taxed in two different ways. Its income itself is taxed, but then its dividends, which are the income it issues to stockholders and stock owners, that's taxed a second way. One more thing I want to point out here. Let's look at a direct example. So what the federal income tax rates are, this was for 2013. This has since changed with recent legislation. But what it used to be is that on your first $9,000, you were taxed 10%. On the next $25,000, you were taxed 15% of that 25. And then on the next 40,000, you were or so, 50,000 or so, you were taxed 25% of your income on that, and increase. Basically, what a graduated tax system is taxed on the for each segment of your income. For example, if you made $25,000 a year, the first $9,000 of it would be taxed at 10%, and then everything past $9,000 to $25,000 would be taxed at a rate of 15%. However, let's say you make $100,000, you do the same 10% on the first $9,000, 50% on the next $25,000, 25% taxed on the next $50,000, and then the last $13,000 or $12,000 would be taxed at 20%. There's a great video from Khan Academy which does a great break. And I also will work to have a video uploaded here shortly explaining this breakdown. So how does the U.S. spend its money? There's a couple of big ticket items. It has income security, the Social Security we've been talking about. This is also things like wage disability, along with social. And notice that this is the single biggest part of U.S. spending, 33%. Comes next at $940 billion, along with $3,000 per person, which is 25%. So this is Medicare, Medicaid. Then we have national defense, which falls up at 19% of federal government spending. Then the net interest rate, which is 9%, and then 14%. These could include things like research grants, own operations. But one thing I want you to notice here, note that 9% net interest. What that's telling us is that the federal government of its budget, almost 10% of its budget, is just dedicated to servicing debt. As the U.S. debt increases, you can expect this net interest on the percentage of federal receipts paid to go up. An important aspect on this, note that income security and national defense are the three big ticket items here. That's important because you'll hear Congress debate what to do over economic policy and what to do over managing the U.S. debt. No one wants to touch Social Security, Medicare, Medicaid, and the national. That's one of the big is you either increase taxes over the 25% Americans typically pay today, or you cut spending in these three categories. And that is a very unpopular thing to do. So beyond this, the U.S. has a couple of outcomes. If the U.S. has an excess of government spending over government receipts, i.e. it spends more money than it brings in, this is what we call a budget deficit. However, if it runs receipts over government spending, i.e. its tax revenue is greater than its government spending, in that case, it runs a budget surplus. Now, we'll look in the next slide and see that the U.S. hasn't ran a budget surplus. And its deficit is basically the rate at which it is accumulating debt. I want to clarify this because you'll often hear scientists or economists say something to the effect of, or policymakers particularly, say something to the effect of, oh, well, we've reduced the reducing does not mean you've reduced the debt. Reducing the deficit means that you're reducing the rate at which the debt is growing. There's some problems ahead for the United States. We have a fiscal challenge coming up, and that fiscal challenge, look at this. Notice that healthcare and income security were the two highest big paycheck items of the United States. Look at how the elderly population as a percentage of the US overall population has skyrocketed in recent years. Notice that spending on Social Security and health programs have stayed relatively constant. This signals a challenge we have ahead because technically this older population should be demanding a much higher burden of spend. And so either their real benefits will have to increase or the real taxes paid and government spending must also increase in this older population. Now, what is this group? Why is there this spike here? Well, you may guess it. This is the baby boomers. So at the end of World War II, there was economic in the United States, and people saw families. When they had these large families, we're talking about two people having families of. So they nearly doubled the size of the family. In contrast, the baby boomers have shifted to only having less than 2 kids per household, around 2 kids, 2.5 kids. So the base of people paying taxes now is much smaller than the people demand, or not much smaller, but is growing increasingly smaller relative to the amount of people that demand those services. And so this is what fiscal challenge ahead. We're going to pivot to the state government. And state receipts and local receipts look a little bit different. So state governments mostly get revenue through sales taxes, property taxes, and a little bit of individual income taxes. So these are their 3 main categories. They like so sales taxes. This is the amount of cash that gets added onto your payments whenever you pay. So right when you go to a restaurant and you pay $8, and then you have for some reason to pay more than $8 price of the meal, that's your sales tax. Property taxes, this is basically the closest thing the US has to a wealth tax. This is a tax on the value of your home, the value on your car, the value on just any real property you're considered to own. You also have individual income taxes. So some states collect a degree of your private income in tax. Note that this is not true over every state. So Georgia's a little bit lower in individual income taxes. In contrast, someone that's really large is states like New York, and you have states like Florida and Texas, which don't collect individual income taxes at all. Some corporate income taxes are collected. But notice too that the other big category here is federal government. What this is saying is that the federal government reimburses a lot of the cash it makes back to local government. Now notice that just because the local and state governments, so for example, and we will see this right here, if we pivot to what state and local governments spend their money on, they mostly spend their money on education. This is one of the big things the federal government spends money on, is the federal government subsidizes state and local education. So state and local education, they're the ones that provide it. They're the ones that hire employees. They're the ones that manage the school board. However, it's often the federal government provides an additional resource to provide for that. Healthcare, well, states also contribute to Medicare and Medicaid. And so the federal government also contributes cash back to help with this. Public order and safety, this is police officers. Income security, states and local governments also have to contribute to helping with Social Security, or they offer their own pension systems for former employees. Highways maintenance, notice that highways don't come up at all on the federal governments, but state and local governments are who typically are expected to manage highway payments and coverage. And interest on state and local debt is only 5%. And then we have 13% other, which these are all the myriad of issues state governments decide to spend their money on. benefits. So, for example, a bunch of states choose to spend their money on things like research, or they choose to spend their money on certain public services and resources. So there's a lot of things that fit into this other category. Now, we wouldn't be economists and studying economics if we didn't talk about efficiency, and taxes do have an impact on efficiency. You might remember this from our earlier chapter. Taxes can create deadweight losses, and the way they do this is they distort incentives and create additional administrative burdens. So efficient tax systems aim to minimize these deadweight losses, and we'll talk about some examples of this. Now, the administrative burden that we mention here is things like the cost of filing taxes, whether in personal effort and time, or paying someone else to do your taxes. So H&R Block, TD, Ameritrade, these are groups that will do taxes for you, or TurboTax, but these are inefficiencies in this. You have to pay someone money to do something because the government has made it complicated. We also have the marginal, pivoting from them. There's also another aspect of the question of taxation, and this is marginal tax rates versus average total. Average tax rates are useful in the sense that they tell us the total taxes paid divided by total income. So it's a percentage, basically, almost of your own. It's a percentage of the total income people have made versus how much they've paid in taxes. And it's useful in understanding the total tax burden and the sacrifice individuals make. So what opportunity and consumption are they giving up to pay taxes? However, the marginal tax rate is much more interesting for policy analysis, and this is the amount that taxes increase from an additional dollar of income. This is useful in identifying how tax rates distort. If you have higher marginal tax rate, higher marginal incomes, this makes the value of those higher incomes less and less because now you're paying more. One of the things that's considered to be the most efficient way of doing this is, well, create a lump sum tax. A lump sum tax means that everyone pays the exact same amount of money. There's some problems with this. Even though lump sum tax is the most efficient tax, efficiency is only one aspect of a tax, and lump sum taxes are a regressive tax. Basically, what we mean by that is it impacts disproportionately lower incomes. So, for example, if I said everyone has to pay a lump sum tax of $2,000, that means nothing if you're extremely, extremely wealthy. For example, if you make $100,000 a year, a $2,000 in tax is only 2% of income. However, if you only make $20,000 a year, a $2,000 tax is then 10%. So it proportionately affects people at the lower end of the tax of the income. This gets us into the concept of taxes and equity. And basically, we want taxes to not just be efficient, we want taxes to be fair. And so the benefits principle suggests that people should pay taxes based on the benefit they receive from government services. To give you a classic example here, you might know that if you go to a gas station, diesel's more expensive than gasoline. Why is that? Well, diesel has additional taxes. Why? Because guess who uses roads more than anyone else? That's right, trucking firms. And so diesel tax is a way of targeting individuals that use the interstate and much more reliant on the interstate and do much more damage to the interstate than anyone else. So a gas tax is ultimately a part of an example of a tax designed to disproportionately benefit the most from it. This leads us also to the ability to pay principle, and this is the idea taxes should be levied on a person according to how well that person can shoulder the burden. Basically, the idea is that, well, Bill Gates is wealthier than the rest of us, so maybe Bill Gates or Jeff Bezos should pay proportionately more in taxes since they can. There's two corollaries to this, and just to be clear, what a corollary is the argument that follows from an already proven argument. So if we think people should be able to pay based upon how much they can shoulder that burden, well, there's two concepts associated. Vertical equity, that's the idea that taxpayers with a greater ability to pay taxes should pay larger amounts. And horizontal equity, the idea that taxpayers with similar ability to pay taxes should pay the same amount. So vertical equity, individuals that have lower incomes should ultimately pay less taxes than the wealthier incomes, i.e., I should pay less tax than Gates, Horizontal equity says that taxpayers that have the same income I do should pay the exact same amount. So that seems reasonable and fair, right? Everyone at the same level should pay about the same amount, and people at higher levels should pay lower. That's simply put the ability to pay principle. We can evaluate vertical equity something like this. Basically, you have three kinds of tax systems. You have a proportional tax, because all taxpayers pay the same fraction. So, for example, this would be everyone paying 10% of their income. That would be proportional tax. You have regressive tax systems, which is what we talked about with lump sum tax. And that's because high income taxpayers pay a smaller fraction of their income despite paying out. And then you have a progressive tax income. And this is because high income taxpayers pay a larger fraction of their income than do low income taxpayers. So it's called progressive because it gets progressively larger the higher your income gets. Now, just to give a breakdown of this, let's consider these three tax systems when someone makes $50,000, $100,000, and $200,000. In a proportional taxes, each of the individuals would pay 25%, so $12,500 for the person that makes $1,000, $25,000 for an individual that makes $100,000, and then $50,000 for someone that makes $200,000. In contrast, a regressive tax would percent of income paid by each individual as they make more money. So notice that the amount of tax still goes from $15,000 to $25,000 to $40,000, i.e., someone that makes $200,000 is still paying more money than someone that makes $50,000. However, the percent of their income they're paying is increasingly less. Finally, a progressive skews this different. So notice that we still have a larger tax paid by people at higher income levels. Notice that the difference here is $10,000 is 20% of the $50,000 income, and $25,000 remains 25% of $100,000. However, the $200,000 income is now paying $60,000 in taxes, or 30% of. So this is simply a breakdown of these three systems. Proportional tax, everyone pays the same percentage of their income. A regressive tax, everyone pays, or you increasingly pay less percentage of your income the wealthier you are. And a progressive tax in which you pay a higher percentage of your income the higher your income is. Now, tax incidence and tax equity. Many discussions of tax equity ignore the indirect effects of taxes and are based on what economists mockingly call the flypaper theory of tax incidence, i.e., the idea that the burden of a tax sticks wherever it lands. Rarely, if ever, is this true. One of the reasons why is just think about, for example, the tax on cigarettes. We mentioned this in an earlier chapter that elasticity affects who pays the tax. Basically, just because we increase taxes on companies and corporations doesn't necessarily mean they're going to pay higher levels of taxes. It might accountingly look that way. However, in practice, it means charging consumers. For example, in the case of cigarettes, a lot of the expense of a cigarette is the tax put on the cigarette, and it's built into the price. So, are we really going to be able to get wealthier individuals and firms to pay more in taxes, or ultimately are we just creating an incentive structure whereby they pay employees less and charge consumers more? Now, one thing I want to add to you, be sure to check out Mankiw's tax expenditure article on page 250. Mankiw actually is the writer of our textbook is a macroeconomist, and taxation is one of the major things he does. Now, final point. Regarding federal taxes, just take a moment to pause here and reflect and analyze at how the breakdown overall taxes paid and the percentage of all income paid in tax for our highest income earners and all these quintiles. Real quick, what a quintile is it is basically 20% of the population. Quintile is basically the 0 to 20% average income of a household. And then the next 20%, that would be 20 to 40%. That is the group with the percent. A final note on this core, this is a debate between efficiency and equity. Like Arthur's Oaken paper, which we mentioned earlier on our videos, we want as productive and economic as possible while ensuring and accepting fairness. And if you check out these videos here, we can see some examples of, do taxes reduce inequality? Are they fair? And also, one of the major policies we use to address these questions, typically known as the Earned Income Tax Credit. All right, we finished our public economy section. Take care until next time.